For most crises, people imagine the moment of collapse as something loud, a bank run, a stock market free fall, a sudden wave of unemployment. But in 2008, the world almost collapsed for a quieter reason. Modern economies do not run on money alone. They run on confidence. Not just confidence in governments, confidence in the hidden plumbing that turns short-term credit into something that behaves like cash. And when that cash-like credit freezes, the system doesn't slow down, it seizes. That's why 2008 wasn't just a housing crash, it was a run on the shadow money system. And in this episode, we are going to decode the pattern that turned mortgages into a near total shutdown, step by step. Because the real question isn't, could 2008 happen again? It's this. After 2008, risk did not disappear. It migrated, so where did it go? To understand 2008, we have to start with the story everyone remembers: cheap credit, rising home prices, and the belief that housing only goes up. For decades, owning a home was treated as the safest bet in the middle-class playbook. And for a long time it worked. Interest rates fell, mortgage access expanded, banks grew confident that they could lend more because collateral kept rising. Then Wall Street discovered a machine that looked like magic. Take thousands of mortgages, bundle them together, slice the cash flows into layers, sell the top layers as safe. To investors, it looked like genius. To the system, it looked like stability. But stability can be an illusion when it is built on leverage and packaging. Because underneath the American dream narrative, the real golden age was happening somewhere else. Inside shadow banking, a parallel banking world that didn't call itself a bank, but functioned like one. It borrowed short-term, it lent long-term, it promised safety, and it depended on constant refinancing to survive. That is the first key to 2008. Now we enter the acceleration phase. The mistakes were not a single villain moment. They were incentives stacking over time. The first mistake was turning risk into a product. In a traditional model, a bank makes a loan and keeps it. So the bank has to care about whether the borrower can repay. But securitization changed the incentive. If you can originate a mortgage and then sell it into a bundle, the goal shifts. The goal becomes volume, more loans, more fees, more product. And as long as home prices rise, the system can pretend that credit quality is not that important, because refinancing becomes the exit and resale becomes the safety net. That is how underwriting standards loosen without a dramatic announcement. Not overnight, year after year. More creative documentation, more optimistic appraisals, more loans written for borrowers who could barely afford the first payment. Because the system was not built to ask, can this person repay for 30 years? It was built to ask, can we move this loan into the machine? The second mistake was a machine that turned shaky loans into safe assets. Here is the core illusion. A bundle of risky mortgages can be engineered to look safe as long as defaults stay within a reasonable range. So the system created layers. Top layers were sold as ultra-safe. Lower layers absorbed losses. Ratings helped sell the story. Not because every person involved planned fraud as a strategy, but because the model assumed the future would resemble the recent past. It assumed housing declines would be local, not national. It assumed correlations would stay low. It assumed liquidity would always exist. In other words, it assumed the world would remain normal. That is one of the oldest collapse patterns in finance. Risk looks manageable right up until the moment it becomes systemic. The third mistake was leverage disguised as efficiency. Once investors believed the top layers were safe, those securities spread everywhere. Banks, pension funds, insurance companies, money market funds, foreign institutions hungry for yield. But the real acceleration came from leverage. Financial institutions borrowed very short-term money to hold long-term mortgage assets. They did this through repos, commercial paper, and other instruments that behaved like cash. This was the magic trick: borrow short-term at low rates, buy long-term assets with higher yields, collect the spread. As long as funding keeps rolling, you print profit. But that is the trap. When you fund long-term assets with short-term borrowing, you are vulnerable to a run, not a run by depositors, a run by lenders who refuse to roll your funding. And unlike old-fashioned bank runs, this kind of run can move at digital speed. At first, the cracks looked small: a few subprime defaults, a few lenders failing, a few headlines. But the system had been built on one assumption: collateral would hold. When housing stopped rising, refinancing got harder. Defaults rose. The lower layers inside mortgage bundles began to absorb losses. Then the system reached the moment that matters most in any leveraged structure. Investors started asking, what is this actually worth? And the moment that question becomes urgent, liquidity disappears. Because buyers step back, market making slows, prices gap down, and once prices fall, leverage turns from efficiency into a weapon. Falling prices trigger margin calls. Margin calls force selling. Forced selling pushes prices lower. That feedback loop is not unique to 2008. It is a collapse pattern in any leveraged system. Now we reach the part most people forget. 2008 was not only banks failing, it was funding markets freezing. The crisis was a run on shadow banking. Repo lenders began to demand more collateral. Short-term investors refused to roll funding. Money market funds faced withdrawals. Institutions that looked solvent on paper suddenly could not fund themselves day to day. And when short-term funding stops, the long-term assets don't matter, because you can't wait, you have to sell. That is the moment a financial system becomes a fire sale machine. And fire sales don't stay contained. They spread losses across balance sheets. They force write-downs. They destroy trust. They trigger the next wave of withdrawals. At that point, the system doesn't need more bad mortgages to fail. It needs only one thing: fear. Fear that you won't get your money back tomorrow morning. That is what a modern run looks like. Not crowds outside bank doors. A quiet refusal to roll short-term credit. Once the panic reached critical mass, the response was not subtle. Central banks became lenders of last resort, not only for banks but for markets. Liquidity facilities were expanded. Rates were cut aggressively. Emergency backstops were created. Governments stepped in with guarantees, rescues, and stabilization programs. And the immediate panic stopped. But stopping a panic does not erase the pattern. It changes who carries the weight. In 2008, the burden shifted from private balance sheets to public balance sheets, from leveraged institutions to central banks, from shadow banking to the official system. This is the classic collapse avoidance strategy. You do not let the system break. You absorb the break. The system survives. But the memory of the rescue changes behavior, and it creates a new fragility. Here is the deeper lesson of 2008, the one that stays relevant. The crisis was not really about houses, it was about fragile money. Modern economies run on layers of promises that behave like money. When those promises are trusted, everything moves smoothly. When they aren't, the system becomes illiquid, and illiquidity becomes insolvency. So the collapse pattern looks like this. A golden age of rising assets encourages leverage. Leverage spreads through instruments that feel safe. Risk hides inside complexity. Then a shock reveals that safe depends on liquidity. Liquidity depends on confidence, and confidence can vanish quickly. That is the core pattern. Now the question becomes the present-day link. After 2008, regulators focused heavily on banks. Capital requirements rose. Stress tests became normal. Bank balance sheets became more conservative. But the system adapts. Risk rarely disappears. It relocates. It moves into new structures, new markets, and new incentives. If banks are constrained, non-banks grow. If one form of leverage is limited, another form becomes popular. If one cash-like instrument is questioned, a new one is created. So the right question isn't only, are banks safer? It's this: what is being treated as stable today because it always has liquidity until it doesn't? What markets today are funded short-term against long-term assets? What parts of the system still rely on constant refinancing? Because that is where the next run would begin, not necessarily in housing, in plumbing. If 2008 taught the world anything, it's that collapse doesn't always arrive as a single, dramatic event. Sometimes it arrives as a funding freeze, a sudden refusal to roll short-term credit, a moment when the system realizes it has been calling something cash that isn't. And the most important part of the pattern is this: the rescue can prevent the crash, but it can also plant the seeds of the next fragility, because when you prevent failure at scale, you change behavior, you teach markets what will be protected, you shape incentives for the next cycle, you encourage new forms of leverage to grow in the gaps. On this channel, we don't just tell history, we decode collapse patterns step by step, and we ask the only question that matters: who is at the same stage right now? If you want to see how these systems rhyme, from Spain's silver boom, to Britain's overstretched empire, to the Soviet command economy, to the dollar order, to Japan's stagnation, and now to the modern credit machine, subscribe to Collapse Pattern. Don't just watch history happen, see it coming.